Hello and welcome to the final market briefing of the year. I'm Chris Ball, a Chartered Financial Planner and Head of Business Development for Kellands. I'm delighted to be joined today by Stephen Bell, Managing Director, Portfolio Manager and Chief Economist at BMO. Stephen's research provides macro strategy for BMO's multi-asset funds, and we regularly share Stephen's weekly updates where he bravely and succinctly airs his views on current events in a changeable world.
Hello.
Okay, so straight in, let's start with the pandemic. It remains the issue dominating both headlines and markets. And recent vaccine progress has provided a chink of light. Is the end of the tunnel now finally in sight?
Yes, I think it is. The experts in this area are unanimous that we have found the solution. Bear in mind that we've had 3 vaccines report. There are another 10 or so, and one of the world's leading immunologists suggests he expects them all to be effective. In addition, this efficacy rate, which for Moderna and Pfizer over 90%, I mean, that is fantastic. Now, it's all a bit weird on the AstraZeneca vaccine, and that's very important for 2 reasons. First of all, well, 3 reasons. First of all, it's cheap. They're producing it at cost as a fraction of the price that the Moderna and Pfizer will be delivered at. And bear in mind that you're going to vaccinate basically the whole population. It's not, it's a big deal. The second thing, fridge. And the third thing, have ordered 100 million doses pretty much for the whole country, whereas for the Pfizer we've only got 4 million coming in the near term, and we don't get any Moderna till March. So, but these vaccines will work. The Johnson & Johnson vaccine, which is a few months away probably, is a single dose and a fridge storage. So we'll have combinations of these, but one way or another it's only a question of timing. There are issues related to take-up, and the National Health Service are recruiting celebrities. Apparently they're only going for serious celebrities, whatever that means. Marcus Rashford.
That is reassuring, Stephen.
Exactly. Number 1 on the list there. And anyway, I think people will take it, and it will allow us to get back to normal. But before we get there, we've got some truly terrible times to go through. Yes, the death rates are much lower with this second wave, but we know from the Canadian Thanksgiving, which is October, they've had a big surge in new cases after that. So the US will have a lot more. We'll have a lot more when we have our sort of eased lockdown. But ultimately, that will all be resolved with a vaccine. And we'll start vaccinating next month, I think, in this country, maybe the week before the new year, a small number of doses to the most elderly.
Incredible stuff. The very positive stage 3 vaccine trial results, they brought with it the collective sigh of relief and wave of optimism in markets. As the year draws to a close, I mean, portfolios are looking remarkably healthy, just considering the scale of the shock the world has faced. Given the recent run, where does this leave the outlook for markets? Have those with cash to deploy sort of missed the boat, or are you more positive about what next year could bring?
I'm positive about next year. Certainly on our modelling, there's a significant upward shift in corporate earnings going to take place probably around February, March. It's difficult to get from here to there. We're going to have a fall in UK GDP in the current quarter, probably in Q1. The US is going to have a terrible Q1 because they're going to have many, many more cases. There's a big expiry of everything from unemployment benefits for 12 million people to various relief packages, all expire on New Year's Eve. But of course, markets will look through that. So earnings will look very wobbly, but then I think we're going to look for quite a good earnings outlook into 2021. And bear in mind that we're going to get onto this, I know, but inflation and interest rates and fiscal and all that sort of things, those fears for the next year at least are overstated. So I think we're in for a pretty decent period. Just last week, I was concerned that this rebalancing effect would wobble markets. Now, what that is a lot of portfolios US pension plans, which are, hundreds of billions, and many other portfolios are run to fixed percentage weights. So when equities rise, you sell equities and buy bonds. And that's a rebalancing process that's fairly mechanical. And because we've had such a magnificent run up in November, you'd have expected selling. And that selling would have particularly taken place in the last few days and the next few days. Well, there's been no sign of that. So I think basically it's telling you that despite the news on vaccines, the run up in markets, a lot of people are behind their targets. There's a lot of cash to be invested. People just haven't believed this rally, were frightened by all the stuff on the virus. So I actually think there's money to go into the market, and I would have thought that it's not too late. It's not too late to buy risk assets. That's my message at the moment, given the background as I see it.
Excellent. So for the remainder of this session, I'd like to fire through some pretty big topics on the UK economy, which are regularly featuring with clients. So in no particular order, you alluded to debt, and clearly this year has been extraordinarily expensive in terms of UK government debt. And there's a great deal of headlines around the need to raise taxes. I suppose the question to you is the Chancellor actually under significant pressure on this?
Well, it's a funny old question. And, I've got a chart on this that we talked about before. We have 300 years of history of government debt in the UK, and it's been much higher than it is now, and it's been much lower than it is now. And the subsequent economic performance seems to be totally independent of all this. We had very low debt after the inflation in the early 70s, and the latter half of the 70s was a terrible period for us. And we've had very low debt and not done that great. So I don't think that level of debt, and there's a good economic theory for that, we've effectively borrowed that money from ourselves. It's not as if we are an individual who have to pay it back to the bank. And when it comes to rolling it over, the British government are rolling it over at historically never before seen low rates. I mean, index linked yields, of course, are negative. So I don't think there's any problem with that. Many people also worry about whether the Bank of England buying this debt, and that's who, Bank of England has bought all the increase in the debt, that somehow that's printing money which leads to inflation. And all the economic textbooks say it is, but actually it isn't going to cause inflation. Just ask yourself, are there upward pressures on wages at the moment? The settlement data that come out are showing nearly all settlements are nil. That's the median, So I don't see inflation.
Interesting. I mean, those with long memories will have that concern of, some of the higher inflation numbers that we just haven't seen in recent years. And quite clearly there, you're not seeing that pressure anytime soon.
No. Yeah. And I think the pressure on wages is downward, not upward, wage inflation. And we'll get some bounces. I don't think you're going to find cheap flights as cheap next summer as they would have been if you tried this year, because they've taken so much capacity out. So there'll be some in isolated areas, but basically, even though many people were forecasting inflation, some leading analysts, Jim Reed at Deutsche, Andrew Garthwaite at Credit Suisse, both highly regarded, were both forecasting inflation to pick up, and they're now backpedaling because, well, there aren't any signs.
Okay. And unemployment, clearly there's just been so much turmoil created from this year. Once support measures start to drop off, is that a meaningful concern?
Yes, it is. First of all, the forecasts of mass unemployment have all been far too pessimistic. The furlough scheme basically wound down, and as it was being wound down, the generosity of it, and of course furloughed workers were not counted as unemployed, but they weren't working. They were just getting 80% of their pay up to a limit. So there's a statistical issue, but basically businesses have not collapsed in the way that many people thought, and the furlough scheme has been considerably extended and is still pretty generous. There will be problems. Many businesses that were teetering on the brink, and obviously the retailers are the best example of this, very much in the news at the moment, they are going to lose, and they were basically businesses that were struggling in the first place. So there will be a rise in unemployment, but I still think people are too pessimistic about the outlook for unemployment in the UK. And the longer term, I don't believe, people call it scarring. You know, the recession's been so deep, businesses will be lost for good. Well, you know, those pubs are still there, even if they're empty, and they might reopen as something else. Some, you know, pubs are another industry which have been in decline. But I don't think we'll have the scarring, because basically this has been such a short and sharp recession that people won't be detached from their employers as they are in a long, deep recession. So I don't buy that either of those arguments.
Okay, so the other big issue that doesn't attach as much attention as it did previously is Brexit. Will we get a deal? And do markets still care?
The markets care. They certainly care. You'll see sterling move a lot if we get a deal, and a lot down if we don't get a deal. We think the odds on a deal are very high. We've felt that for some time, and that's now beginning to be priced into the market. And you've seen sterling rise. Last time I looked, it was 134, and we are now. There've been so many deadlines. We've passed half a dozen of deadlines, and we are coming up to the deadline because you can't leave it till New Year's Eve. But the last thing to be sorted out is fish. We will do a deal on fish. It's in economic terms irrelevant, but politically it's terribly important, particularly the French, who are playing hardball on this. And the solution is going to be a transition period. So we want a deep reduction in the amount of fish that the European Union can catch. They don't want that. So what we'll do is have a long transition period, years, maybe longer, that will make no change initially, I suspect. And that is to placate the French fishermen who would otherwise blockade Calais, which would be an interesting start to the new year. But there's still a risk it doesn't happen, don't get me wrong. But negotiations will go on and on, by the way. We haven't solved everything with this rather limited deal. There'll still be disruption, by the way, in January. We'll still lose a lot of non-tariff barriers, and services aren't really helped, financial services in particular. But I think we'll get a deal, and I think it'll mean that we can start our new relationship, somewhat more distant economically from Europe, but on good terms. If we don't get a deal, it'll all be finger pointing and acrimony. So we don't want that.
No. Okay. Thank you. And finally, what are your thoughts on the US market following what's been an incredible year in 2020 and obviously Joe Biden's victory?
Yes, well, it's amazing. The US has produced these global superb companies. I mean, they are not just capital light, most of them. They're labor light as well. They just generate stuff out of almost nothing and are making huge profits. And regulation is a risk there. Had Joe Biden's party taken control of the Senate, and they have to win, there's two runoffs in Georgia on January the 5th, because neither side got over 50%. And that's because there were third candidates that spoiled it. But it's very unlikely the Democrats win both. So they won't have control of the Senate, means they can't pass legislation that the Republicans don't like. So there will be limits on that, but I still think regulation is a threat. One of my colleagues was pointing out that Yahoo peaked a month after it entered the S&P 500. Well, Tesla, sell the stock and buy a car might be the recommendation there if you already hold it. But I'm not a stock picker. And I think that we could see positive returns from the US market as earnings get revised up. We've got a big debate on in our shop of value versus growth, and longer term growth still looks good. Remember, interest rates are so low and growth produce their earnings in the longer term, and therefore when you discount them back, it does favor growth. And the real interest rates in the world are very low, particularly in the United States. So I think we'll be okay for the US market. I'm not overly positive on the UK market, not as negative as we were. In Universal, we've reduced our underweight significantly and bought some sterling to hedge what we have. So we're not as negative on the UK, but we think emerging markets will do well. That's really our sort of outlook for relative performance in 2021.
Okay, well, I could talk to you about all of these issues. We could probably hold a separate call on all of them, I suspect. So thank you for running through such a wide array of topics there. Given this is our last briefing of the year, it's just an opportunity to say thank you to you, Stephen, for joining us today. And of course, to wish everybody viewing a Merry Christmas from everyone at Kellands.
Well, thank you. And I'd just like to wish you and your clients not just a happy Christmas, but a prosperous 2021. I'm confident it's going to be a better year in every way than 2020.
Well, a perfect note to end on now, I think. Thanks very much, Stephen.